one is income statement. The second one is the balance sheet or financial position statement. So within those two main statements that we saw, current asset and current liabilities are in which statement?
Balance sheet.
Balance sheet, very good. So now when preparing, calculating current ratio, immediately we need to think about balance sheet because it's where we need to get our figures from. Okay, so current ratio equals to current assets over current liabilities. We also have another ratio to calculate liquidity, which is acid test or quick ratio, if we can say it, quick ratio or acid. It is just, we take the current assets and we minus stock, then over current liabilities. So now if I can also ask, where do we find the stock? Where do we find the stock in both statements? In which statement, either income statement or balance sheet? Which one do we find the stock in? Remember the format?
Is it not in the balance sheet?
Yes, it is in the balance sheet, but remember also when talking about cost of goods sold, stock is also included. So stock appears in both income statement as well as balance sheet, okay? But now that we are analyzing after the period of the business itself, we need to get it from the balance sheet. Thank you so much. So now we keep on with our lesson. Suppose we had some figures in our balance sheet that current assets equals to, for example, the value of 2,000. And current liabilities, it's maybe, let's take an example of 1,500. So it means that current ratio will be equal to 2,000 over 1,500, isn't it? So it becomes even very easy to calculate. Very good. So now we see another type of ratio, which is gearing ratio we saw yesterday, or leverage ratio. We said we use this ratio to measure at which extent the company uses its assets, which have been financed by non-owner supplied funds. So these are not the funds from the shareholders. Now we need to measure at which extent the company uses them. Okay, so now it is said one of them is debt ratio or capital gearing ratio. This measures the proportion of debt finance to capital employed by a company. By the way, this is a technical term, capital employed. When talking about capital employed, this is all that the company is using to run out the business. So a company is highly geared if ratio is greater than 50%. So you understand that when calculating, this need to be the measurement. Now, debt ratio, the way we calculate them, we take total long-term debt. Now, if you remember very well, where do we get the total long-term debt in the balance sheet? Because in the balance sheet, remember, we have 4 elements. We have current assets, non-current assets, current liabilities, non-current liabilities. Okay, so this needs to be by heart. And also we need to know all the elements within current assets, non-current assets, current liabilities, non-current liabilities. So if you can remember very well, where do we find in the balance sheet the total long-term debt or long-term loan?
In the non-current liabilities.
Non-current liabilities. Thank you so much. So now, if we know where to get the long-term debt, which is non-current liabilities, and now we have the capital employed, everything that the company currently owns to run the business. So we times 100, then we get what? Debt ratio to calculate what? Gear ratio. Okay, so I don't know if you have any question by there. If there is none who has a question, we proceed with debt equity ratio. Now,
is there any reference for the good run of an institution at a certain level of debt ratio that an institution should not go beyond?
Yes, it shouldn't go beyond 50%.
50.
Yeah, and also in calculating ratios, we get the result in percentages. So the percentage should not go beyond 50%.
If a company is starting, it isn't possible even to go beyond 50, because at the beginning, normally for all projects,
yes,
it is not easy to have their own capital.
Yes,
it's not easy. So at the beginning, it's always possible even to request some loans.
Yes,
that can go beyond 50 if we estimate that our business can also generate more income to pay back the loans.
Yes.
So if we go beyond, is there any problem?
In fact, in the beginning, each and every business has to start with this phase of introduction phase, whereby most of the time they are not making a profit. That's a lot. Of course, it's a problem because the business itself is at risk, but also it's one of the business life cycle. Yeah. Okay, so I don't know if there is any other question. Otherwise, we tackle debt equity ratio, which measures the proportion of non-owner supply funds to owners' contribution to the company. A company is highly geared if the debt equity ratio is greater than 100%. For the previous one, we saw it is when it is greater than 50%, but now it is greater than 100%. So debt equity ratio equals to long-term debt. The same, we find it in the balance sheet in non-current liabilities over equity or net worth. So equity, remember the accounting equation, which is equal to assets equals to, somebody to complete me, assets equals to accounting equation, assets equals to liabilities.
Owners, liabilities and owners or capital. Owners.
Thank you so much. Yeah, or equity. That is, so now we take equity, long-term debt that we find in non-current liabilities over equity, then we find debt equity ratio. It's just as simple as that. Okay. Now we also need to calculate terms interest cover. Under which ratio? Under gear ratio. So this shows the number of times earnings by the company cover its current payment. So how many times? The higher the ratio, the lower the gearing position, that the lower the financial risk, and it is understandable. So times interest cover is calculated by taking earnings before interest and tax plus depreciation. Where do we find the depreciation? On non-current assets, right? Depreciation is calculated over non-current assets like equipment, machineries, cars, and so on. Then over interest charge. We also have ratios to calculate profitability. Remember, we saw for profit-making organizations, we saw types of organizations and how to calculate a financial statement for them, especially for profit organizations, and profit organizations. Now for profit organizations, we saw two targets or objectives. First one is profit maximization and wealth maximization. Profit maximization mostly concern managers, while wealth maximization mostly concern shareholders. So now profitability ratios, it measures management's effectiveness as shown by returns generated on sales and investment, what they get on return of their investment. So first point to calculate profitability ratio, we have return on capital employed. Remember what we talk about capital employed? This is everything that the company needs to run the business. So we expect the return on them. Return on capital employed, this measures the efficiency with which a company uses long-term funds or permanent assets to generate returns to shareholders. How to calculate return on capital employed? We take profit before interest and tax, or what we call operating profit, over total capital employed, everything that the company is using to run that particular business. Okay, so I don't know if there is any question. Otherwise, what I was saying about capital employed, this is the shareholders' funds plus long-term debt. So it means that everything that the company is using to run that business. Capital employed can also be calculated as fixed assets plus net working capital. Another thing to calculate profitability ratio, we have gross profit margin. This ratio shows how well cost of production have been controlled in relation to distribution and administration cost. So now, within gross profit margin, we have different subtitles. Net profit margin. This measures firm's ability to control its production, operating, and financing cost. How to calculate it? We take the net profit over sales times 100%. 100, of course. So because the margin need to be in terms of percentages. Net assets turnover, this is another way under profitability. This gives a guide or guideline to productivity efficiency. How we are being efficient in production. How well assets have been used in generating sales. How do we calculate net assets turnover? We take sales over capital employed. Okay. Okay, so now we have another under profitability, which is operating profit or margin ratio, if you want. This indicates efficiency in which costs have been controlled in generating profit from sales. Now the calculations or the formula, we take profit before interest and tax, or operating profit. We divide by sales, then we times 100. We also have operating expenses ratio, which indicates the company's ability to control production and operating cost relating to production to generate a given level of sales. Now the formula, we take the operating expenses over sales, then we times 100. Okay. Now return on investment. So we have invested, we expect the return on investment. This measures the efficiency in which a firm or a company uses its total funds in capital employed to generate returns on owners' funds. Now, return on investment, we have net profit after tax. If I can ask, where do we find the net profit within the two financial statements? When do we find the net profit? Isn't? Yes, somebody? Okay.
Hello.
Yes.
Hello, sir.
Yes.
I think you've put the answer up on the screen. Are you asking for the return on profits? It says that it's the net profit.
Yes.
And then you do after you multiply tax by 100 and divide that with the capital that you had actually invested.
Yes.
Or are you asking about something else?
No, I'm just asking, where do we get the element, that element of net profit in financial statement? Do we get it in income statement or in the balance sheet? Because this is what is important for you to find out where to get the information to fill in the formula.
Okay, I missed the last part of yesterday's class, so I'm not sure.
Okay.
Income.
Yes.
It is found in income statement.
Income statement. Thank you so much. So, income statement, this is the last element in the income statement, net profit. So we have the figure, we just fill in the formula over capital employed, then times 100. Okay, thank you so much. Now we have return on equity. Equity, this is shareholders' wealth that they have brought. So they expect something in return. This measures the efficiency in which a company other suppliers funds to generate the return to shareholders. So how to calculate? We take earnings attributed to equity shareholders over equity times 100. Just as simple as that. Yes? Okay, thank you. We proceed. Now, we go to another element of activity ratio that we even saw yesterday, which measures the efficiency in which a firm uses its assets to generate sales. Okay? Maybe a lecturer of Prof can tell much about the concept of efficiency and effectiveness in management. I know he can tell more. Okay, so now when we are given resources, what do we expect? We expect to maximize the outcome from the resources we are given. Okay, so now these activity ratios, we actually measure the efficiency in which a farm uses its asset to generate sales. Now, some of the elements we have debt turnover. Debt turnover shows the number of times debtors pay within the year. It indicates how efficient the company is in management of credit. The higher the ratio, the more efficient the management is in managing its credit policy. How to calculate debtors turnover? We take credit sales, then we divide or over average debtors. Then we get the answer. Okay? So now, is there anyone who has an idea of where to get this element, credit sales and average debtors within the financial statement? Where to get them? Is it in financial income statement or in the balance sheet? Remember, where are sales? Sales are in the income statement, right?
Yes.
Average debtors. Where are debtors? Now, by average, you need to understand that we will divide by 2. Okay? So now we understand where to get the element, the figures from, either in the income statement or in the balance sheet, which is important for us to analyze the financial statement. Okay, good. Now we go to debtors day, or what we call debtors days ratio. This is also called average collection period. It shows the average period of credit taken by customers who buy on credit. It is compared by companies' allowed credit period by suppliers to give an indicator of credit administration efficiency. Now the formula. We have average debtors. We know where to get debtors from in the financial statement, times number of days in a year. How many days do we have in the year?
365.
365. So we times by 365 over credit sales. Sales on credit. Okay? So then we get the debtors days ratio. Another element is creditors turnover. Now this is the opposite of debtors turnover. This indicates the number of times creditors are paid by a company during a year, and it is very important in decision making. So the formula is simple. We take credit purchases over average creditors. Then we get the ratio. Now we have creditors days ratio, the opposite of debtors days ratio, which is called also average deferral period. It indicates the average of time that suppliers allow a company to set its dues, to know at which specific period we need to pay back. So the formula is simple. We take the average creditors over 2 times number of days in the year, which is 365. So credit purchasers Another way, the way we can calculate them, we take the number of days in the year over creditors' turnover. I hope it is understandable. So now we go to another element. Stock or inventory turnover. It is very important to control stock in business. This indicates the efficiency of a firm in selling its product so as to generate sales. It shows the times stock is turned over and converted into sales within a year. It shows how rapidly stock is being turned into cash through sales. And also after aligning in what we call cost accounting, other techniques and the stock, what we call last in, last out, or first in, first out, or last in, first out. These are the techniques we use when managing the stock. So now the stock turnover, the formula is as simple as cost of sales over the average of stock. It means we take the whole of stock, then we divide by 2. Now, stock days or inventory conversion period. This indicates the number of days it takes to convert inventory into sales. And it is very important for any person who is managing the stock. The fewer the number of days, the more efficient a company is in converting the stock into sales. So it means our efficiency in managing the stock will be based on the period we actually keep the stock. The fewer days, the more efficient a company is actually managing a stock into sales. The formula is simple. We take the half of the stock, the average, times a number of days in the year over cost of sales. Or in other way, there is another way we can calculate it by taking the number of days in the year, 365, over inventory turnover. Okay, so now we go to cash turnover, or what we call operating turnover. This shows number of times a company needs to replenish its working capital in the year. The formula is very simple. We take the number of days in the year, 365, over working capital cycle. Okay? We also have another element, which is fixed asset turnover. This indicates level of sales generated by fixed assets. Now, remember, when talking about fixed assets, what do we mean? We mean houses, we need land, we mean land. So all the assets which are fixed. It shows the efficiency in which a company utilizes its assets to generate sales. Now the formula, we take sales over total fixed assets. Then we get fixed asset turnover. Now, we go to investment, or what we call equity ratios. Some call it investment ratios or equity ratios. They are the same. These are used to evaluate the overall performance of the company. So, and it is very key. It is very key because we all need to know how the company or the organization is performing. Now, some elements under investment ratios, we have earnings per share. You know, as the business is actually generating income in recording net profit, which is positive, shares also increase in value. So earnings per share indicates the amount of shareholders expect to generate in form of earnings for every share invested. It shows profitability of a company on per share basis. So if a share has increased in value, it means that the performance is not bad at all. Earnings per share equals to earnings attributable to equity shareholders over number of ordinary shares. Okay, it's very simple. So we just take what? We just take all the earnings to equity shareholders, then we divide the number of ordinary shares we have in the company. Okay. Another element under investment ratio, we have dividend per share. This represents the amount of cash dividend that shareholders expect to receive for every share invested in the company. Now the formula is as this: total ordinary dividend, and we divide by the number of ordinary shares. We also have another element, which is dividend payout ratio, which indicates proportion of earnings attributable to equity shareholders that are paid out to common shareholders as dividends. It is used in analysis of dividend policy of the firm. Now the formula which is used, we just take the total common dividend, we times 100, we divide by earnings to equity shareholders, then we times 100. In other words, we take a dividend per share times 100 over earnings per share. Okay, I don't know if there is any question by there. What is important in analysis is, first of all, to understand what you are calculating and what you want to analyze, and what will the result help you in your decision making. Secondly, you need to identify where to get the figures from, either the financial statement, the income statement, or the balance sheet. Then you apply the formula, it becomes very simple. Dividend retention ratio, which is calculated by taking retained earnings over earnings attributable to equity shareholders, and you time 100. We also have dividend cover. Dividend cover, these are earnings per share over dividend per share. It means what? It means earnings per share, which is there, and which also determines the value of the current share over dividend per share. Okay, so earnings yield also, which is another element. This measures the potential return that shareholders expect to earn for every share invested in a company. So since shareholders expect some return on equity on their shares, this also needs to be analyzed. It evaluates the shareholders' returns in relation to the market value of a share. Okay. So talking about market value of a share, we need to understand this. As the business makes profit, shares also increase in value. Okay. So now when calculating earnings yield, we take earnings per share over market price per share times 100. Then we get the ratio. Now we have dividend yield. This is the ratio that measures how much an investor expect to receive from cash dividend every share purchased or invested in the company. It is very important for shares to calculate this, to know what to expect from what they have invested or also one invest in that particular business. So we just take dividend per share times 100 over market price per share. We also have another element in investment ratio, which is price earnings ratio. This indicates how much an investor is prepared to pay for a company's share given its current ratio, current earnings per share. The higher the price earnings ratio, the more confident investors are that the company will do what? Will perform well in the future, okay? So this shows the outcome which is positive. Now we have, after analyzing all the financial statements, we need to understand the subjectivity of these ratios. Ratios are subjective to accounting information. Remember, anything we calculate or all the formulas that are applied in financial statement analysis, the information needs to be outsourced from the financial statement. Without financial statement, I mean income statement and balance sheet, we cannot calculate, analyze the financial statement. So all the information are the accounting information. Its relevance is that ratios are historical figures which may be irrelevant in making future decisions. They may be relevant or irrelevant in some cases. But its usefulness, ratios are computed at a specific point in time. By the time they are analyzed for decision making, circumstances that might have changed. In this case, ratios are only useful in the short-term period. So now I don't know if you have any question before we proceed. You know, today is the end of our course. I hope we shall deal with a kind of evaluation.
Okay, I have just a contribution.
Yes.
Because here we see that we were required to calculate many ratios.
Yes.
And there is a necessity to observe that such ratios are particularly for profit organizations. So for the case of non-profit organizations, there is no need of such a calculation of
Yes.
different ratios.
Yes.
So here, it is really important to know in accounting such ratios, because in profit organizations, these have also a clear indication on how to invest, how to choose where to invest. Because when we want to invest, we have to put on balance.
Yes.
In which project can I invest?
Yes.
That will allow me to generate more profit,
Yes.
more return on my investment.
Yes.
So it is important to know this. Also, in terms of global management, we have raised the issue of managing organization with efficiency.
Yes.
And managing organizations with effectiveness.
Yes.
We have to understand that there is a relationship between the two concepts. For both managing with effectiveness and managing with efficiency, all have to reach organizational objectives.
Yes.
But the way such objectives are reached, that is the whole difference. So for effectiveness, whoever is reaching objectives by allocating resources, not necessarily in efficiency manner, he is also effective. But he may not be qualified as efficiency in reaching such objectives. Because when you are reaching such objectives with efficiency, it means you are also allocating resources with optimal way of allocating. So by using what is really a rational allocation of resources. So that's by also attaining the highest performance of achieving objectives.
Yes.
That's fundamental. So even in the business companies, the investors, you will see that they have to analyze such ratios to see if they are investing their money, they have already anticipated the highest profitability. So for them, they do not invest just to invest. They invest because they see the good future, the outcome that will be more profitable. Because for them, investors normally it's the money which is working for them. So their money is working for them. Even if they are not really in good condition, their money continue to generate profit. So
Yes.
it is different with non-profit organization.
Yeah.
Thank you. That was my contribution on this.
Thank you so much, Prof. Is there anyone who has a question or a contribution?
Yes, please, Professor.
Thank you.
I just wanted to add on to what Professor Baptiste was saying. It's extremely important for us to understand these things as believers, because I know several of us right now are in different careers.
Yes.
And some of us are working for governments, or we're in private institutions that may not necessarily be Christian. And there are certain rules that we might be forced to follow, which are against biblical values. And this course should help us to aspire to open our own, to start our own businesses, run our own institutions, so that we are free of the restrictions of other organizations that we may be bound to. Because as Christians, whether we like it or not, we have to pay for our houses. Our families must eat. So we may find ourselves in situations where we have to choose between pleasing the Lord and surviving in the world.
Yeah.
So it's extremely important that we understand these things so that we can finance the kingdom of God.
Amen.
Amen. Thank you so much.
Thank you so much for the contribution.
Yes.
Yes. Anyone else?
Yes.
Okay. I'm still waiting. If there is no anyone, we have a couple of questions to evaluate our knowledge. Somebody has a question or a comment, a contribution?
Yes, Professor, I would like to just ask, okay, you were explaining the differences between the normal profit organizations and the non-profit organization when it comes to calculating, or the ratios that you should be used. But I didn't get I didn't get I didn't get it very well, the difference between at the non-profit. How is it calculated? Because since it's a non-profit, what are the measures that are used to calculate? Because you're not really investing, or you're not really doing anything that generates profit.
Okay. Okay, the difference between non-profit organization and the profit organization is also based on their mission. Their mission of organization, for example, non-profit organization, they are there to fulfill social mission. For example, if we take a faith-based organization, a church is there, for example, to spread the gospel. So they are there to evangelize and help people to get hearts saved. So for them, they are not really looking for dividends. So their self-satisfaction is to see how lives of people are changing. If also we take an example of our university, Revealed World University, our mission is to enhance education of all students who are joining our university. And we are empowering